Brett Swarts, Capital Gains Tax Solutions. In this video, we're talking about cryptocurrency and capital gains tax. It's important to understand what your capital gains tax liability is before you exit. You want to build a capital gains tax exit plan prior to exiting, because guess what? Somewhere between 20 to 30% is going to be taxed on the gain, so you don't want to get caught without a plan. So let's define what your tax liability is going to be. Number one, what is your basis? Your basis is what you bought the asset for, the coin for. So if you bought it for $100,000 and you're selling it for $1.1 million, your basis is $100,000. And your gain in this situation would be the sales price of the coin, $1.1 million, minus the basis, meaning you have a $1 million gain. So what is your tax liability on that? Well, it's somewhere between 25%, probably pretty much minimum, to about 30%, depending on what state that you live in. It could be as high as 33%. 35%, depending on what state you live in as well. This is just a general rule of thumb. Make sure you check with your CPA. But I'll give you an example of a client that we helped close a $5 million Bitcoin exit. She lived in the state of California. She was facing 20% federal and 13.3% for the state of California. So it was a massive tax of about $1.85 million. So what options does she have? Well, she wasn't charitable. If she were charitable, or at least charitable at this age, she would potentially use a charitable remainder trust, which allows you to have some tax write-off, defer some capital gains taxes, and give it to charity. Although it's not as flexible when it comes to how you can invest the funds and the ability to be entrepreneur, which leads us into our favorite strategy, which is called the Deferred Sales Trust. And this strategy gives you the ability to be an entrepreneur, to invest at optimal timing, and have diversification. Diversification, we'll start with that one, has to do with two things. Number one, the assets that which you can go into, and number two, the timing of which you can go into those assets. So let's start with the assets that you can go into. You can go into real estate. You can go into businesses, you can go into stocks, you can go into cryptocurrency, you can start your own company, you can partner with the trust. In other words, this gives you the ability to exit. Let's say you had a $5 million Bitcoin gain, put all of that $5 million into a trust, and this trust now owes you the money back over a period of time. While the money's there, it can work with you and for you, and you can slowly build wealth or quickly build wealth depending on what you go into. And so the ability to do that in a free flowing trust is what we call not only cash flow, but we call that tax flow. So diversification of asset types and asset classes is really important. And the second part is diversification of time. Dollar cost averaging and the ability to sell high and buy low is what every single investor wants, right? Timing is the most crucial aspect of any investor's outcome, whether it be the time horizon or the timing of buying into markets when it makes sense, selling when it makes sense. As a cryptocurrency investor, perhaps you have a sense of when it's a good time to sell and a good time to buy, and that capital gains tax is holding you back. Well, you want a strategy like the Deferred Sales Trust that can receive the capital and give you the diversification of timing markets. And so those are the two things that I would really focus on with the Deferred Sales Trust as it pertains to diversification. Now, what about legal track record? Well, you want to make sure the strategy you're using has a legal precedent or has something that it is backing, meaning it's not something new that you're just trying for the first time. The neat part of the Deferred Sales Trust, it goes back over 27 years, thousands of closes, and it's had over 25 no-change IRS audits. And so it's batting 1,000 when it comes to the legal track record. That's really important to understand because legal track record will determine whether or not your tax strategy works. And number two, whether or not you can sleep well at night, which is so important when it comes to the Deferred Sales Trust, that it gives you the ability to sleep well at night when you're exiting highly appreciated assets. Some of the other things to consider when looking at capital gains tax for cryptocurrency exits is just what the cash flow could do for you, right? What the diversification could do for you, and what it means for legacy wealth planning, and how much impact you can make with the wealth. At Capital Gains Tax Solutions, we're focused on helping people not only unlock capital gains, but then to go make an impact and freedom with their wealth. That means different things for different people. But having a strategy and having a plan in place and a team to help you execute that is what unlocks, I think, wealth, not only preservation, but also wealth creation. And so these are just some of the things to consider when building a capital gains tax exit plan. You can go to capitalgainstaxsolutions.com to learn more about how we can help you. Thanks so much.